Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is December 14th, 2023, and we're going to talk about wild swings following the great Fed pivot. To start with, we're going to look out to May for the May 2024 Fed Funds Futures. Now, this is a tool that you can use. It shows in the pricing, and it's not just the predictions, the projections, but it is the indication or the expectations of the market, but they're pricing it and paying for it. So I look at this as we can speculate on what the Fed's going to do, but in the end, the Fed Funds Futures are literally traders or investors or analysts putting their money where their mouth is. And so if we're looking out to May 24, what we can do is we can calculate the expected interest rates out to that time frame. A year ago, if we're going back to the beginning of 2022, we're looking at the number right through here, and it's about 96. So if we're looking at that 96 back in that level, what we can do is we can take 100 and subtract off 96. That is telling us that back last year in 2024, we were seeing signs that we should expect that 100 minus 96, in other words, a 4% interest rate. But that's a 4% interest rate projecting or predicting all the way out to May of 2024 at the beginning of 2023. So it is a forward-looking view. It is something that we look way out in the future to get an idea of what we might think might happen. And back then it was 4%. The pivot that we're talking about is this low in the analyst expectations or the Fed Funds Futures traders expectations. So back here in September, October of this year, we hit a low and we started to price in not rate hikes. All of this is going lower and lower and lower is rate hikes, but we started pricing in rate cuts. So the lowest level we got was 94.60 for May of 2024. So 3 months ago, we had a rate, if you want to go like this, 100 subtract 94.60. We were estimating or predicting that in May of 2024, we would have a 5.4% rate. Now that's about where we're at. Okay, that's where we were and that's where we kind of held. So what we're seeing is that after we put in that low, that's the interest rate we're at for the Fed Funds Futures. And since that time frame in September and October, we started making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And as long as this is moving higher, we are starting to predict or anticipate or project an expectation of a lower rate. So as of today, really from yesterday, we went from 95 to about 95.11. And from the low to the high, we went 0.20. So we could say that 0.20 increase in price or rallying up there is an 80% probability of a rate cut being priced in. Now that's not the total rate cut, but additional rate cut just with that big green candle. Now let me zoom in on this and give you a little bit closer view. What we're seeing here as of today, at the end of the day, we tried to go higher. We went all the way up to 95.225. Now, if we're looking at a 95.225 rate, what does that equate to? Let's go ahead and run the math on it. So we take 100, subtract out 95.225, and at one point today, we spiked all the way up because of the dovish comments from the Fed, because of the pivot that we had back in September, October, but this acceleration breaking us out from yesterday's behavior, yesterday's response to the Fed not raising rates and their guidance. We now are pricing in a 4.775. That's the interest rate we're projecting by May. That's what the Fed Funds Futures are telling us. So our current rate, if we're looking at our current rate and then projecting this forward, what's the difference? Our current rate is about 5.375. So we're pricing in most of 2 cuts. In fact, let's go ahead and run the calculations on this again. If we're at 5.375, that's halfway between the 2 areas that we're at. We're projecting it down to 4.775. We are pricing in a 0.40. That means we're pricing in a full 25 basis point or 25 basis points, 0.25, a quarter point. And that leaves us with 0.15 of 0.25. And that would argue that we are pricing in a 60% probability of a second rate cut by May. Now, that's not all that we're getting, because it's not just from the Fed funds futures that we get this estimate. We can actually look directly to the Fed. Now, this is the St. Louis Fred data, St. Louis Federal Reserve, and this is their dot plot. And this is showing you the FOMC summary of economic projections for the Fed funds rate. So they're looking at the median, the midpoint of all the expectations based off their economic predictions. And as you can see, by 2024, we're looking, or the end of 2024, we're looking at a 4.6 rate. Now remember, we just calculated a 4.77 rate for May. So we're expecting 2 rate cuts, maybe a third by the end of 2024. But this is the part that gets a little bit more nerve-wracking, is that we're now looking out to 2025 that we could see it drop to 3.6%. So if we're going to go from 3.6 to 5.37, we're talking about a 1.5% drop, and then as we go up to 2026, all the way to 2.9. So if we're dropping to 2.9% by the end of 2026, this is a big indication that we're going to see multiple rate cuts, and multiple rate cuts are being justified by the Fed, according to the St. Louis Federal Reserve, based off of the economic projections that we're going to see more and more rate cuts to the point where we're talking about 2.375 or more. We'll say at 2.5% drop. Now, 2.5% is 10 rate cuts over the next 3 years. Now, if we watch the price action, specifically the Nasdaq here, on how the market responded and reacted to what we're seeing in the equity price action after the Fed, really before the Fed and after the Fed, you're going to see these dramatic swings. The Federal Reserve comes out, leaves rates alone, and starts to talk. And what do we see? Instantly, cheaper money, equities higher, and we push it skyrocketing higher, and we go from about 590 up to 790, so 200 points in under an hour. Then we pull back and we break out again. We pull back about 100 points, and we go from 690 all the way up to 890 roughly. And so we do another 200-point rally. So 200 points, 100-point pullback, 200 points. So in just the time from the Fed announcement to post-market or overnight, we see a net total of 400-point rally in the Nasdaq. And you think, okay, we're pricing in high, strong equities, rising equity strength, rising commodity strength, weakening dollar, all because we're going to see lower interest rate, cheaper money, and more theoretical growth. Well, as we're watching this, we see that the market starts to digest it in the middle of the night and says, well, maybe we've gone up too high too far, and we start making these lower highs and lower lows. As we open up today, the market starts to see those same 200-point swings, 100-point swings. We go from 870 all the way down to 740, 750, so about 150. We swing back up 100, and then we drop from 820 all the way down to 620, another 200-point drop with a 100-point rally. And so these swings are becoming violent. They're becoming aggressive because the market does not know what to do with this. If we're cutting rates, not just that we're stopping raising rates, not that we're pivoting only, that we're changing our posture from the Fed, but we're now saying we're changing our posture and we're predicting or planning the future, according to the St. Louis Fed, that we will see rate cuts all the way down to sub 3% over the next 3 years. Why would the Fed be cutting if we have inflation still, if we had growth to back it up? And I believe the market is realizing that this rate cut being priced in the future is showing that we are afraid, that the market is unsure, that we do not have the growth, and the Fed is trying to preemptively get ahead of it by making money cheap and trying to prop up the market, trying to hit that Goldilocks zone as they've talked about, that soft landing. But reality is they're already pricing in a major economic slowdown. And so as we process it and say, hooray, cheap money, and we push prices all the way up, we start taking these, again, violent swings up and down. We erased all the price action. If you look over here, all the price action to pre-Fed. This is the pre-Fed meeting through here. We went all the way back to that previous resistance, almost to the tick. We pulled down through here and broke out. So in essence, we're simply saying that resistance area, the price level we determined from Wednesday morning, right at the open, pre-Fed, was the value that we felt like the market was reasonable, and we pulled all the way back. We erased it all. And in this time frame, we've created lower highs, lower lows, lower highs, lower lows, and right now we're possibly creating a lower high again, which means I would expect a minimum retest down here at 650, if not lower highs and lower lows, and erase all of this bullishness. We are starting to price in uncertainty. If we're going to stop raising rates, that's one thing. But the fact that we're starting to talk about cutting rates, or at least putting it on the dot or the dot plot, we're talking about cutting rates, which is cheaper money and therefore more inflation. And I think that is represented very well with gold prices, that it's not just that we're seeing it adjust and saying it's cheap and we need to reconsider because maybe that means we have a recession coming, but gold shot higher but did not sell off. Gold ran not just the 200 points like we talked about on the Nasdaq, and 200 points is getting you close to about a 1% move on the Nasdaq. So as we saw this move, we saw a 2.5% move yesterday in gold, and then we held and went higher at 3.38% run up, and the pullback didn't even pull back to below yesterday's overnight price action. Gold is held up here, showing that there's a lot of strength in the expectation of inflation and gold needing to be the hedge. If we're not going to raise rates or hold rates higher, then gold needs to be the hedge. We have to have a hedge. Additionally, we can see it in crude. Crude also rallied yesterday. We rallied ahead of the Fed, and then at the Fed we continued a little bit higher, but today that just continued to shoot higher and higher. Crude prices have now gone from Wednesday's lows to today's highs of 7% increase. If the dollar is getting beat up against other currencies like the dollar index is through here, what you'll see is the dollar has lost its purchasing power. This is pre-Fed, this is Fed meeting, and the US dollar has lost today at its low about 2%. And we pulled back a little bit, but that 2% drop through there should see about a 5% rise in equity indexes, and maybe as high as 10% rise in individual equities. But as you can see, if it's about inflation, the dollar did not gain strength, just like gold did not give back its strength after that response. And that's what we're seeing. The dollar stayed weak, gold stayed strong, crude stayed strong, copper stayed strong, and equities faded. We are pricing in inflation and uncertainty as we move forward looking at this new Fed pivot. And the last thing I want to look at is comparing the 10-year Treasury yield versus inflation, and inflation being defined as the difference between gold and bond prices. So let me get rid of the stochastics. This is a price ratio just comparing gold to bonds, gold to the 10-year bond specifically. And if we look at the 10-year bond as a zero risk or a no risk trade and compare that to gold as the inflation hedge, and you can do the same thing with general commodities as well, but this is an indication of not just inflation, but inflation with the inflation hedge. So we're comparing gold to bond prices, and when it's rising and reaching new peaks, this is an indication of a lot of inflation. And just so you can see that 2016 we kind of bottomed out, and we've pushed higher and higher and higher and higher. This most recent move is showing inflation remains relatively high, and when we drop in yield, we usually accelerate in inflation and needing a hedge. As we've watched the yields go higher and then pivot off the top, even though this is an area that we'd start expecting to see inflation drop as yields remain higher, we did not get inflation to respond to the higher interest rates. So the fact that we're seeing yields drop and pricing in lower and lower levels, we've gone from almost 5% to 3.93% as of today. This fall should see inflation turn back up, and we should be heading to a new high when comparing gold to bond prices. That is not good for the overall economy. We might see a support level here. We might see a support level here. And if we see those drop into these levels, then we could expect these types of moves again, like we saw when it dropped before. So I am looking for that inflation to accelerate higher and as yields go lower. All in all, I think we can see it right from the best responding sectors and commodities. Crude's up 3.18%, Energy is up 2.81%. Gold is up 2.68%. Real estate is up 2.47%. Copper is up 2.32%, and basic materials are up 1.6%. Top performing indexes and sectors and commodities are all about inflation today. And so we are pricing in a lot of inflation. That should be a concern to us because the Fed is not raising rates anymore and possibly going to be cutting 2 times next year, maybe 3, and as much as 10 over the next 3 years. That's going to do it for me today. Thanks for watching. We'll look forward to talking to you again next week.